Friends, today we are going to cover three important aspects related with this topic. That is the introduction, that is financial statement of non-corporate entities, all the basic thought process concept behind it, guidance note of ICAI, and the position of auditor in this. So taking ahead the session.
Thanks a lot to both of you to provide me an opportunity to share my views. It is indeed a pleasure to be associated with five esteemed organizations and set of more than 120 attendees. It, it is indeed a challenging time, both on a personal front, what we see in what is happening in the world around. At the same time, the challenges are there on the finance and the auditing side as well. One of the challenge rightly identified is the one that we are going to talk about today. Change is nothing but a part and parcel of life. So you can't move away from the change. It may so happen that way that in an initial time, we may have a problem in accepting the change. Many of the time the changes probably are not brought in, or change would not come as desired by us. There may be anything. Only thing is that we need to live with it, and then we need to carve out our way, how to proceed from that maze kind of a thing. So let's start with the presentation. We'll discuss certain issues, or how the best we can have it in the challenges that we are having right now. I think that's feasible, right?
Yes.
Okay. Yep. If you have any questions, you can post it on the chat box or a Q&A. We'll have in between the time or at the end of the session, we can take that as well. In the meantime, Kenan, you can just keep a tab on it, so I don't miss out any of the questions of any of the members.
Sure. We request our participants to post all the questions to the chat box. We will take all the questions at the end of the sessions. Thank you.
Yeah, sure. Okay. So let me start with this presentation, financial statement of non-corporate entities. I'll be calling NC throughout the presentation. ICAI has issued a guidance note post issuance of a technical guide. And what's the position of an auditor? Is it like between a rock and a hard place? हिंदी में हम बोलते हैं एक तरफ कुआं एक तरफ खाई. So is that a case? Let's dig into it, and let's see to it where we stand and what are the changes that we are required to do on this. So as I stated, we are at a crossroad, we are at a maze. Don't know where to go, how to cross this entire maze, and whether we'll be in a position to successfully complete or come out of this. So we'll start with this one. This is what would be dealing in today. I'm not sure I'll be able to finish off entire thing in the time, but I'll try my level best to finish it off within the allotted time. We'll have an introduction. We'll check into it whether what's the role of an ICAI or authority or document issued by ICAI. A lot of people have a set of questions onto it. Applicability of guidance note. What are the challenges, the important one for the members? Format of financial statements. We'll quickly run through all reporting formats, and we'll also have, yeah. I think someone else's mic is also on.
We'll mute them. Please continue.
Yeah. Okay. So we'll be looking into the challenges in implementation as well, and thereafter we'll be discussing on format of financial statement. Few of the important points also we'll be discussing on too. Applicability of accounting standard to NCEs, which are the standards that are applicable, and how to deal with those standards, and reporting in case of non-compliance. So I think that would cover entire part of the questions or the gamut of questions that we would have into this aspect. So the institute has issued this guidance note on NC. There are two guidance notes issued. One is on this one and one is specifically on LLPs. We'll be looking into the journey so far, various publications and objective and scope of guidance note in this. If you look into the journey so far, June 2022 was the time when the technical guide on financial statement of NC was issued, along with the technical guide on LLP was issued. Later on in August 23, more than a year thereafter, it was converted to the guidance note. Almost 99% the same part was there from a technical guide to the guidance note. It was made mandatory from 1st of April 2024, reporting from 1st of April 2024. NC includes anything which is not a company. However, while issuing the guidance note, the institute has issued two separate guidance notes, that is one for an LLP and one for other than LLP, other than companies, that is NC other than LLP. More or less, you will find that both guidance notes are almost on the same line. So what we'll be doing is we'll be restricting ourselves to discussing on one part only. However, if anyone would have any question, we can discuss the other part as well. So as I stated, technical guide was issued on June 22 and which was converted in a guidance note. Same way it was for an LLP. Now comes to the objective and scope of guidance note. A lot of you would have a question that what was the need of this one? Rightly so, there are a lot of unorganized sectors and sectors are there in the business terms. Likewise, lot of financial statements are also not in an organized format. For companies, there is a Schedule 3 and specific guidance is provided in the Companies Act itself. And the guidance note is also issued by, a detailed guidance note is issued by ICAI on it. However, the problem lies with the other entities. Barring few, there are no regulations wherein the formats of financial statements have been prescribed. So the issue is that one business or one business entity would be reporting in certain way, other would be reporting in certain way in terms of financial statement presentation. So a need was there. In case if we want to move further, we want to accelerate in terms of quality of reporting standard, reporting aspects. That was the need, and institute has rightly stepped in that arena. Initially, they had a technical guide, and then based on the comments and the response from the members, it was converted to a guidance note. So the main objective was the standardization of format for the FS, in the sense financial statement for NCE. So that actually gives a parity. So all financial statements would be on the same line. It aims at enhancing quality and comprehensiveness of financial reporting. A lot of reporting was made only with a very brief or rather non-detailed manner financial reporting, say generated from an accounting system and just signed off. So institute, in any case, institute had its publication on framework on preparation and presentation of financial statements since years. However, it was a need that if a standardized format is prescribed by institute, that would be a greater benefit to everyone. It aims to bridge the gap, that is where the formats have not been prescribed and the formats have been prescribed. So wherever the formats are not there, it is prescribed to this one. A lot of people, including the clients or the assessees or auditee, has a question, what's the role of ICAI? The members also have questioned on this one. So ICAI's role is very clear. ICAI has authority to issue various types of publications, that is technical guide, guidance note, auditing and accounting standards, and other special purpose publications. Now, in August 2023, there were a few questions posed to ICAI with respect to applicability of or the authority attached to the documents issued. So ICAI has come up with a very detailed guidance on this, that which are the documents which are issued by the institute and how which authority would they be having. So just to say this one, that let's say a technical guide is issued, or say a guidance note is issued. So whether guidance note has any weightage, or if a member is not agreeing to what is mentioned in guidance note, what can go wrong, or what kind of issues that the member can invite. So basically what institute says, let's go through what's there on the screen first. The institute has from time to time issued guidance notes on a number of matters. With the formation of Accounting Standard Board ASB and the AASB, Auditing and Assurance Standards Board, accounting standards and standards on auditing are being issued. So now, with this formation of these departments, the accounting standard and standards on auditings were issued separately since years before. Members have sought guidance that what would be the level of authority attached to the various documents issued by institute and the degree of compliance required in respect thereof. We need to understand first that whether these documents are of important in nature in terms of adherence. If at all a member is not adhering to, what can be the consequences for the member. This note is issued to provide this guidance. The note that ICAI had issued, it states that I have kept only the relevant portion. Guidance note, though recommendatory in nature, are issued to assist professional accountants in implementing the engagement standards and the standards on quality control issued under the authority of the council. By and large, guidance notes are recommendatory in nature. However, it specifies certain things in detail. So there are two aspects of guidance note. One is guidance note on auditing aspect, and one is guidance note on accounting aspect. So let's first understand the guidance note on an auditing aspect. Guidance notes are issued to provide guidance on other generic or industry specific audit issues, not necessarily arising out of a standard. Professional accountants should be aware of and consider guidance notes applicable to the engagement. A professional accountant who does not consider and apply the guidance included in a relevant guidance note should take reasonable and adequate care in performing the alternate procedures adopted by him to deal with the objectives and basic principles set out in the guidance note. In such situations, a professional accountant should also document the rationale in performing the alternate procedure. So what it states is that institute would have given a specific guidance or a generic guidance on various aspects or an industry specific issues. It may so happen that as a member, you are not inclined to, or you differ with it, or probably your audit case is exactly not fitting into it, and you have your own set of review mechanism whereby you have ensured that the quality of auditing and the reporting, whatever is required, is adhered to. So in that scenario, for auditing related guidance note, you can override what institute has stated. However, the same is required to be documented and noted in the audit documentation. Then comes the accounting aspect. Similarly, while deciding this attest function, a member should examine whether the recommendations in a guidance note relating to an accounting matter have been followed or not. If the same have not been followed, the member should consider whether, keeping in view the circumstances of a case, a disclosure in his report is necessary in accordance with the engagement standards. However, it states that is with respect to the guidance note on accounting aspect, if you are deviating from what is prescribed in the guidance note, in that scenario, a disclosure in the report is necessary in your audit report. Now, the question is the guidance note that was issued by an accounting standard board. So it is on an accounting matter and not on an auditing matter, meaning thereby it becomes a mandatory for a member to adhere to. And in case while doing an attestation function, if it is not adhered to, the auditor is required to make mention thereof appropriately in the audit report. So let's now see to it the applicability of guidance note part. We'll be discussing on type of NCs, exemptions, and the effective date. And thereafter, we'll move on to the next part. Guidance note on financial statements for NCE was issued by accounting standard boards. As discussed earlier, guidance notes are generally recommendatory in nature. However, guidance note for accounting is mandatory. If not followed, appropriate qualification in report is required. So let's now discuss on the type of NCEs. We have sole proprietorship firms and the individuals. We have HUF, all where the business or the economic activity is going on. Those only would be made applicable here. Partnerships, whether registered or an unregistered partnership, association of person, uh, partnership firms which are not considered in above, or the body of individual, or the RWAs. Society registered under any law from the time being in force. Trust, private or public, registered under any law for the time being in force, or unregistered trust. Statutory corporations, autonomous bodies and authorities, any form of organization that is engaged fully or partially in any business or professional activity is included in the type of NCE. LLPs, for that, there is a separate guidance note available in the by the institute on the line of the NCE guidance note. Now, the point is the exemption side. Now, what the guidance note states that where the specific formats have been prescribed by statute, that is, let's say in case of a public charitable trust, there is a separate format, specific formats are available. In that case, this guidance note is not required to be implemented, and the format given in that particular statute is required to be followed. In case of an educational institute, political parties, there are separate or the specific formats have been prescribed. In that case, that those formats will prevail over this guidance note. That is on a presentation side. Effective date, the guidance note is effective for financial statements covering period beginning from 1st of April 2024, meaning thereby this 24-25 financial statements, which we would be auditing now, or we would have already commenced that part, would have this guidance note be having an applicability. The technical guide on the financial statement of NCE stands superseded by this guidance note. So now the technical guide is not applicable or not even active. It has been archived. Now the important one, the maze, the challenges in implementation. First part, concurrence of management. Auditing would always would say that guidance note is not applicable to the auditee. It is going to be a very important part of explaining to the auditee the requirement, the need, the benefits that it will have. At the end of the day, the presentation is the responsibility of the management. So the management is required to be educated with respect to the formats or the benefits that it gives a credence to the financial statement. Many of the time when the auditee is not going, but the financial statements are going somewhere, say for the banking or for the regulator, the financial statement would become the face of the auditee, and that would say that, or that would probably depict the picture of the auditee if it is properly presented or neatly presented in all required this one, that shows the level of compliance or which gives an additional confidence to the reader of the report. However, at the end of the day, that would be the concurrence of a management whether to implement this particular format or not. We'll have a discussion at the end what in case something is not implemented or entirely it's not implemented. However, if management is of the view that they don't want to implement this one, I would suggest that always have a confirmation in writing, since there will be an qualification from the auditor's side. Without having a confirmation, written confirmation from the management, and without sharing the draft qualification text, it is not appropriate for a member to issue a qualified report. So in case the management is not concurring with this aspect, please follow the process that is prescribed by the institute in this regard. Assuming that the auditee says that yes, we are fine with it, let's implement it, then the second problem comes at the availability of data for disclosure. It is quite extensive. The members who are already doing audit for the corporate entities, they would be aware of this format is almost in line with the corporate entities. There is an exhaustive data requirement in case of implementation of this one. Are we ready for it, or whether we, in the sense auditor and the auditee, are ready for it? If not, we need to work onto it. We need to get the house in order first, and then we need to ensure that we move on to this part. It may increase the man hours in preparation, both at the end of the auditee as well as the auditor. It is going to be a challenging task. These formats are not easy as it was done since years. So I would say that the auditing may be 50 years since when the entity would be running since 50 years. But now a sudden and a drastic change is there in terms of financial statement or the reporting or the formats of the financial statements, which requires a lot of disclosures. So we need to be ready for it. We need to ensure that our staff at our offices are also equipped with this one. All the formats should be ready before commencing an audit, so that once the audit is over, the same can be made use of. This time we have some respite, though I would not call it respite, but temporary respite in terms of an income tax returns. It has been that is been extended to 15th of September. So we have some time right now, I would say, because only few of the return formats have been prescribed. So I would suggest that these 2-3 days or a week right from today can be invested into this and as an office as a whole. As far as other part is concerned, excessive information regarding auditing. One of the major concern that this unorganized sector or the non-corporate entities would have is this, that we do not wish to provide excessive information that you are seeking through this one. Reason being, this financial statement goes in the hand of various regulatory agencies, various banks, and some other places where there is a chance of leaking of information which may be detrimental to the business interest of the entity. Some are genuine concerns as well, because not all have a very handsome margin on which they do a business. If it is received by any of the competitor, the entity may have a problem. So in some cases, I do agree that there is a problem. However, the time has changed. The manner of doing a business would also undergo a change. So it's better to have a now a strenuous path. I would say that's a difficult path that we might need to take. For an auditor's perspective, with this all increased requirement, man hours, and excessive informations to be reported or whatever, whether there will be an additional fees. Now, I would not be talking anything on this, but I'll be leaving it on to you. At the end of the day, the fees of an auditor is not based on the turnover of a entity, but it is on the investment of the time that the auditor is investing into preparation, review, auditing, preparation of the for the audit. So that all should be looked into. And with the increased data disclosures, the audit would also require an additional time onto it. So is it possible? Let's have a direct line between the entire maze and we'll go straight out. Let's try. I'm not sure whether we would have that kind of straight path available now for this one. So in this, we'll discuss important points on financial statement disclosure. We have a lot of queries on rounding off, whether the financial statements are required to be rounded off. Important general instructions that are there in the guidance note, the format of the balance sheet, the statement of profit and loss, cash flow statements, notes, other statements, and explanatory materials forming part of financial statements. Basically, the financial statement would include balance sheet, statement of profit and loss, wherever applicable or where it is uh, optionally implemented the cash flows, but the notes and the statements and explanatory material would be the part of the financial statements. So many of the members would always say this, that even the notes and the accounting policies and etc. is not applicable to the non-corporate entity, which is not correct, because the accounting standards are applicable, though with some kind of exemptions, but the disclosures, the accounting policies are very well applicable to the financial statements of NCEs as well. So if we are into that assumption that probably only balance sheet and P&L generated from an accounting system is signed off with UDIN, so would suffice. So I would differ completely on that part. The financial statement must contain the notes and the accounting policies, how the accounts have been drawn, and the related explanatory statements as well. Going on that, or taking a step further from that, the formats that the this guidance note has prescribed. Let's go one by one. The rounding off. In Companies Act 2 years before, an amendment came in wherein it has made mandatory, because of the change of a word, it has made mandatory that all financial statements of a corporate entity is required to be rounded off. Even today, I am not in a position to understand or even gather the reason for doing so, especially for the reason that even the AOC form, AOC 4 form filing requires actual amount to be entered. The tax audit requires actual amount to be entered. The GSTR 9(9)(c) is also requiring actual amount to be entered. However, the financial statement was made to be prepared with the rounded off figure. So eventually, what has happened is the auditors and the managements were required to prepare two sets of balance sheet, one with the rounded off and one with the actual numbers. Frankly speaking, I don't know what's the benefit that it serves if my balance sheet size is not that much, right? And then there is no point of rounding it off unless there is a case where the numbers are running into thousands of crores and the rounding off is done so that there is a meaningful display of information rather than excessive information. However, whether the question is whether the rounding off is applicable for the NCs as well. So let's now go into what is stated in the guidance note. Depending upon the total income of non-corporate entity, the figures appearing in the financial statement may be rounded off as given below. Now, when we compare this with the Companies Act Division 3, it shows that Schedule 3, that it shows that the word used is shall, and that made the rounding off mandatory. However, at present, the guidance note says it may be rounded off. So if at all, if we would like to go with the rounding off, we can go ahead in this fashion. In case of an entity with less than 100 crore turnover, it can be rounded off in hundreds, thousand, lakhs, or million. And in case of more than 100 crores, it can be near as lakh, million, or crores. However, if you want to present it into an actual, you can do it because it's a may be rounded off and not shall be rounded off. So that I think clears off the air. Then one of the major aspect in this instruction part or the format part is current versus non-current classification. Those who are already working with corporates, they are all aware of. However, those who do not have exposure on the corporate clients, I would take some time here. It basically deals with the operating cycle of a company. So operating cycle means that whether you can match. So the moment you make the product in case of a manufacturing or the services, that is initiation to the end, right? What's the operating cycle of a company? Basis on which you determine that whether your realizable things or your payables will be settled in the company's operating cycle. If the company's complete operating cycle is, let's say, 6 months or an 18 months, so it will be determined that if anything less than 18 would be uncurrent in case of an 18-month cycle, anything more than 18 would be a non-current classification. Now, what happens is we need to review the expected amount to be realized or settled, that is in the case of a liability in company's operating cycle. The assets are held primarily for the purpose of being traded. So it should not be the case where other than the trading part, or trading in the sense that is for the business purpose and not for the just for an investment. This part for investment, there is a separate guidance for current and non-current classification. The asset is expected to be realized or the liability is expected to be settled within 12 months. There is no possibility of being deferred. Now, assuming that, how the 12 months come into play, if an operating cycle could not be defined, or by and large it will be considered as a 12 months for realization part or a settlement part. However, we need to ensure that if at a later date, if this particular asset or a liability can be deferred or an adjusted after 12 months, then it cannot be a current one. It would be on a non-current classification only. So whatever which is not current would be classified as a non-current one. So why this is important? Because while preparing the financial statements, there will be at different places, this particular set of reporting would be required under current and a non-current classification. So at that point of time, this would be important. Now comes the operating cycle, the one that we discussed, is the time between the acquisition of an asset for processing and then realization in cash or cash equivalent. So you start with the acquisition and you end with the realization part. Where the normal operating cycle cannot be identified, it is assumed to have a duration of 12 months. So when you don't have a normal operating cycle which is not identifiable, you presume it to be 12 months. So anything which is due within next 12 months would be a current one. Anything which is getting due after 12 months would be a non-current one. Please understand, this is very important. I'll come to that part where we may have a problem in case of this particular aspect. At the later, after some few slides, I'll explain you that where it can hurt the client. The trade receivable and the trade payable. There's a definition given in this format. What is to be considered as a trade receivable? That is, till now we used to call it sundry debtors and sundry creditors. It is in respect of the amount due on account of goods sold or services rendered in the normal course of business. In many of the cases, we may tend to believe that way, that anything which is receivable and having a debit balance will fall under trade receivable. No, that's not the case. The case is, it is only with respect to the account on account of goods sold or the services. Likewise, the trade payable, it is in respect of the amount due on account of goods purchased or services received in normal course of business. Right. So we need to have a distinction between the two. So a loans and advances or an advance given to the creditor cannot be termed to be a trade receivable. Right. So at the time of while finalization of balance sheet, the auditor should look into that all the accounts that are there under trade receivable heading are actually a trade receivable as per the definition given herein. Institute has shared the Excel file as well. So it's an exhaustive Excel file that is shared by Institute, wherein you can make use of that Excel file and you can prepare the financial statements. There are notes also linked to it. So there will be formulas there as well. If you see the balance sheet format, it's a vertical balance sheet, not the T shape or an horizontal one. It requires 2 years presentation. That is a comparative disclosure is also required. There is a problem. There are few issues with this Excel part which we should be just correcting. Equity and liabilities should be replaced with the owner's fund. So that's only a minor mistake is appearing therein. So that can be corrected therein. If you see at the top, there is an amount in rupees XX, meaning thereby in case there is a rounding that is done, you need to mention the round off in the which decimal the round off is there. And it should be applied across the board. So you can't say that for balance sheet, I'm using 100 rounding and for notes, I'll be using actual. No, it has to be on a uniform basis. Let's look into it. You have an owner's fund, you have non-current liabilities, you have current liabilities, right? So now the current non-current would come in play here. You have an asset under non-current asset, you have PPEs, that is property, plant and equipment. Along with the intangible asset, there are four parts: a PPE, intangible asset, CWIP, and IAUD, that is intangible asset under development. Thereafter, there will be a non-current investment, deferred tax asset on a net basis, that is on an asset side, long-term loans and advances, and other non-current asset. Likewise, we have in current assets, we have an investment. We have an investment under non-current as well as current. Inventories, trade receivables, cash and bank balance, short-term loans advance, and other current assets. As can be seen, that the significant accounting policy is also part of the financial statement, and the accompanying notes are also integral part of the financial statements. So basically, this is what is the format that can be used. Let's go one by one. Owner's fund. Now there are certain issues or certain points that we need to understand here. In case where it is a proprietorship form, so in that case, we need to appropriately change the disclosure. The disclosure says that in the maximum disclosure that is required is what is there in front of the screen. Now, in case of a type of a different type of an NCE, say in case of an proprietor case, that will be a capital. In case of an EOP, there will be a member's contribution. In case of a non-profit organization or an NGO, there will be a corpus. So we need to appropriately change the format of this one. However, basically what it states is this, that the name of the partner, in case there are more than one in the business owners are there, all the changes, that is the opening balance, the additions, the accrual of any income to the person, the withdrawals, the share of profits, and the closing balance is required to be disclosed. In case there is fixed capital and a current capital, it is required to be disclosed in a separate manner, right? However, let's understand another issue or a dimension that is in vogue right now with respect to an impact on 194T, that is TDS on remuneration and interest or commission to this one. Now, can we have, because a lot of members had a question that can we have a specific disclosure with respect to partner remuneration and interest on partners capital account? I would say that yes, it's an additional disclosure that you are making. Mainly the purpose that appears to be is that this disclosure would have greater clarity on whether any remuneration was withdrawn during the year, which may entail an earlier date for TDS applicability. And if there is no withdrawal of remuneration or interest, then the date of credit, that would be a 31st of March, would become, in case it is appearing, if it is carried out on 31st March, that would be the date. And accordingly, 30th of April, as per the present provisions, the date of TDS would be applicable. A lot of queries were there. What will happen in case someone would have withdrawn it in advance? So as per the TDS provisions, the payment or credit, whichever is earlier, would be invoked therein. However, in case if you create or if you have everything jumbled up, it may create problem or it may be end up it may end up with assessing it that way, that remuneration or the capital interest on partner capital were also withdrawn, and thereby the TDS default would come in play. So yes, that can be this separate format can also be there. Accordingly, the previous format should be redesigned. Then comes the reserves and surplus, an important one. Need to understand this part. If let's say if it's a proprietorship, it will definitely go in the first the previous one. However, in case of a partnership, the firm has decided not to distribute the profit. So firm has decided to keep it with the firm as an undistributable distributed surplus. In that scenario, in the previous this one, the share of profit and loss would not be there. In that case, it should be reported under reserve and surplus at part D, that is point D. Now, that is what is the balance in the profit and loss statement, and that will remain under reserves and surplus. Now, what happens if there is a debit balance of statement of profit and loss as negative figure under undistributable surplus? So in that scenario, earlier what we used to do, we used to show it on an asset side. However, in this guidance note, it is categorically stated, even if it's a negative, it should be shown under reserve and surplus as a negative item. So that would, I think, clear a lot of issues that are there. Now comes a challenging part, the step one by one. If we will go ahead, and there will be the challenges would increase. Just imagine that you are in a maze almost at a center, and now you are finding it difficult to identify. So now we have a borrowing. As you all know, in case of an non-corporate entity, there are a lot of loans from the banks or an NBFC or relatives or the family members or friends are there. How to ensure proper reporting under long-term and a short-term loan? Now, let's understand first the format, and then let's understand the issue therein. First part is the secured and the unsecured. So we need to ensure that the bifurcation is there on a secured and an unsecured. Within secured, we need to first mention the term loan, and the priority would be given to the banks, where the fixed repayment or a specific repayment amount is prescribed, that goes under the term loan side. Then comes the loans repayable on demand. Now that would be definitely on a short-term side. Deferred payment liability, in case any liability is deferred, then it would be under borrowing, and we need to check it up whether it is for a short-term purpose or a long-term purpose. If it is secured, then only we need to mention it from this. The loans and advances from related party, if secured, to be reported under secured. If unsecured, at the second part. Long-term current maturity of finance lease obligation, in case of finance lease, it's applicable, or other loans and advances which are of a secured in nature. Now come to the unsecured part. Generally, what we'll find is that related party loans and advances are unsecured ones. So it goes in the second part. The important ones are there in the footnotes. Nature of security to be specified separately. Each type of security offered is required to be specifically mentioned therein. Terms of repayment of term loans and other loans shall be stated, meaning thereby what are the terms of repayment, say a monthly installment, and what amount or till what period, that is the loan expiry date, what's the rate of interest, right? So all these terms are required to be disclosed. Where the loans guaranteed by partners, proprietors, or the owners aggregate of such amount should also be disclosed under each head. So at times it may so happen that way that the loans are availed by, let's say, partnership firm, but the partners or the relative of partners have also given some guarantee. So we need to mention under each type of loan that whether it is guaranteed by the partners or the relative of partners. The question would arise that in many of the cases that the loan is availed for the business, the asset, let's say an immovable property, owned by an individual partner. Let's say we are talking about partnership firm, where a loan is availed from a bank. but the building or the immovable property owned by the partner in individual capacity is offered as a security, additional security or a primary security. So in that case, whether the loan would be a secured one or an unsecured one. So that's an important question. In terms or from the perspective of the banker, or while you read the sanction letter, it appears that way it's a sanction, the secured one. However, if you look into from the reporting perspective, it becomes an unsecured one. Reason being, the asset that is given as the mortgage is not the asset of the NCE. So in that scenario, we need to mention that these assets belong to so and so person, and hence the same is reported under an unsecured one. However, if it's a culmination of both, that is some asset of the NCE as well as some individual assets, we need to report it accordingly. Now, from where this stems, so there is a guidance note on Schedule 3 on Companies Act issued by ICAI. It at para 8.3.1.14, it refers to when promoters. Now that is with respect to company, but we can have basis thereof because that's almost on the same lines. When promoters, other shareholders, or any third party have given any personal security for any borrowing, such as shares or any other assets held by them, disclosure should be made thereof, though such security does not result in the classification of borrowing as secured. Right. The other question that a lot of members are asking is unsecured loan from relative, friends, etc., whether to be treated as long term or a short term. Now that's going to be a very challenging task. Many of the times the terms of repayments are not specified. In that case, what is to be done? In case it is reported as a short term borrowing, there can be an issue with respect to the availability of finance as well. And if it is on a long term, then it may not be in sync with the transactions that are there in the particular loan accounts. So please ensure that way that the proper disclosure and the bifurcation is carried out. Whether the documentation for terms of repayment is available or not, if not, those documents are required to be called for. Then comes the other long-term liabilities. It includes unbilled use and long-term trade payables in case there are any. That's a residual part. Then comes the long-term provisions, provisions for employee benefits, that is gratuity and a leave encashment, or other provisions. Again, if you can see on screen, it requires long-term and a short-term bifurcation. So any of the provision which has a validity or which is only for a less than a period of 12 months, it goes under short term. And if the provision is for a longer term, it goes for that is more than 12 months, it goes under the long term. Then comes the trade payable. It goes exactly in line with what is prescribed under the Companies Act. The trade payable would be reported in two parts, that is total outstanding dues to micro, small and medium enterprise and other than MSE. Now, what happens is it also requires a disclosure for relating to suppliers registered under MSME Act based on the information available with the company, and there is a detailed disclosure for therein. Now, that's only there is an issue with respect to that Excel file that the word company is used. You can change it to the type of your client. So, amount remaining unpaid to any supplier as at the end of the each year, where it is on a principal or an interest. Then the total amount of interest paid by buyer in terms of 16 of MSME Act, and likewise that's there. It is not clear under which statute the disclosure is required. However, we only follow the statute now with what the guidance note says. So it is more of an beneficial in terms of the compliance with respect to the MSME Act, and hence the same is required to be done. A lot of auditors had questions on this one, that what happens if management certifies that there are no MSME dues. Rather, there are no MSMEs with whom they are dealing with. So that would be a very important question to understand, that what is the authenticity of the statement or a confirmation that the management would have given. There are Related compliances under income tax, that is 3CD now 43H. That 43BH is also there. And this year there will be an increased reporting requirement. So I would suggest that always have a parity between the reporting in this clause in tax audit report along with this one. So it should not happen that the financial statement says something whereas the tax audit report says the other thing. So it has to have a perfect syncing into this one. So better course is to prepare a comprehensive a template whereby all such information is captured. So that will be used for both the financial statement as well as for the tax audit report. Then comes the other current liabilities. The current maturity of finance lease obligations, interest accrued but not due on borrowing. So let's say the borrowing, the interest run is on a in between the period and not the year end. So in that case, it will come here. Interest accrued and due on borrowing. Income received in advance. Now, please understand these all line items, many of the line items are non-revenue, all would be impacting the GST reporting as well. That is GSTR 9 and 9C. So be cautious, understand where you are reporting. Otherwise, it may happen that if any erroneous reporting is carried out, then it may create more problem for your client. So please understand in which line item the reporting is being carried out, and then the tax liabilities, GST and TDS and other payables. These are all current liabilities. The other major ones, or the one where the issue would be, is a PPE, that is property, plant and equipment. And that's what the major change, or the, I would say that the problematic area in terms of implementation. So the format says that we need to have a gross block and a accumulated depreciation model, rather than reporting only on the net WDV method. Now the question would arise is that since years or since ages, the client would have used the net WDV method. Now, is it feasible, or how is it feasible to get the gross block? Now, if it's, there are multiple ways to address this issue. Again, members can have their own opinion as well. I am sharing what I can suggest. If it is the entity has is started since few years only, and if the data is available in the system, that can be reclassified in this manner, and an entry is required to be recorded in the books of accounts while debiting the asset and crediting the equivalent amount of a accumulated depreciation. The problem would arise in case of a very old NCE where only WDV is available. Now, there is no concrete solution even with me as well right now. I'm giving you my personal opinion. Again, don't consider it as an opinion of an institute or my firm. What can be done with all due notes and everything is that whatever is the WDV that is available should be reported in gross block. And from particular day, let's say 1st of April 2024, whatever are the additions, you report it as a actual figure and keep an accumulated depreciation. Please understand this. This is only a way around that I am saying is it's not feasible, or rather I would also have a problem in stating that way my gross assets are so and so. However, I'll be, as a member, what I'll be doing is I'll be putting an across an appropriate note stating the challenges that are there and the way around that you have carved out or carried out into this one. So that's the point. It says that the land, building, plant and machinery, office equipment, furniture and fixtures, vehicle, or any other type of assets are required to be disclosed. Again, 2 years disclosure. So starting with first year, addition deductions, same way in the second year as well. So meaning thereby the previous year disclosure is also required. It is not mandatory that to have this format. You can have the freehold land, building, plant and machinery again on a first column side and the other side on the multiple columns. So columns would not have an impact much over it. However, the essence of reporting should be ensured. Likewise, you have an intangible, that is goodwill, brands and trademarks, computer software, mining rights, or other type of intangible assets are there. Same would apply with this one. Amortization values also we need to extract it in case it's feasible from previous years. If it's not feasible, again the same set of note is required. In case of CWIP and IAUD, the disclosure is required to be in this format, that is opening balance, addition and capitalization during the year, that is a deduction part, and there will be a closing balance. The problem lies is with this one. The members say that a lot of management would adhere to the depreciation method which is available in the income tax department, or whatever income tax department states they follow. Now, whether that is appropriate in terms of an accounting standard, so that's the question that the members would have. I would like to explain some part here. Accounting standard deals with what is depreciation, what is useful life, and how the depreciation should take place or would have an impact on the financial statement. In case of following an income tax department formula, even an asset which was purchased on, let's say, 29th of September would have an entire year of depreciation, whereas accounting standard 6 deals with depreciation is allocated so as to charge a fair proportion of the depreciable amount in each accounting period during the expected useful life of the asset. Now, the question arises, what is useful life? It is the period over which an asset is expected to be available for use by an enterprise, or the number of production units. So we'll skip the number of production unit. So what it says that the year till which the asset would be expected to be available for a use of an enterprise. The question here comes is whether NCEs would have technical documentation stating that way, that which asset would have how much it would be the useful life. If that is not there, how a depreciation computed would be the correctness of the depreciation computed. So in my humble opinion, that if the formula of income tax department is used where there is a block method, it would required to be disclosed in as a qualification stating that it is not matching with the accounting standard 6 and the 10 prescription. Now the question here comes is that it is not feasible for all NCs to obtain technical documentation or useful life. So again, this is my personal opinion. A reference can be made to the Companies Act Schedule 2, wherein there is a detailed list given where the Companies Act states that if no technical documentation is available or it's not obtained, the minimum prescriptive number of years useful life is prescribed therein. So that can be taken a base and a depreciation can be computed therein. However, whatever is the assumption, now this is an accounting assumption, is required to be included into the accounting policies and the and notes to accounts wherever it is required to be presented. So what we need to do is we need to ascertain what's the useful life that is considered, what's the method of depreciation that is considered, whether it is consistently being followed, or if it is being followed or if there is a change, then the impact of change, because that will be a change in the accounting policy, right? So this is what is all about PPEs. Then comes the investment side. Again, an Herculean task that we need to report in certain manner. It has various distinction. One is non-current and one is current. Other one is quoted and unquoted. Quoted means the investments which are quoted on a stock exchange or freely tradable. So that goes under the quoted investment. Then there are other type of investments where the investment in preference shares or unquoted equity shares or the government gilt securities or a trust securities, debenture, bond, mutual fund, investment in property, right? And other non-current investments. Same way, it goes with an unquoted one, investment in other entities, and likewise it goes through. Now the point is, again, a non-current and a current distinction is required. The non-current is the one where the intention of the management to hold it for more than 12 months, and which is not routinely traded. This one goes under a non-current this classification. Whereas the other ones would other would go into the current one. So you have non-current reporting, you have current reporting. Within both, there will be a quoted investment, unquoted investment. Within the quoted, you have an investment in other entities that is directly invested into an entity which is of a group entity, I would say on a simpler term. And then there are other investments, right? So you have all gamut of things here. In case of an investment in LLP or a partnership firm, details of all partners, the profit sharing ratio, and the capital balance is required to be disclosed. So assuming that your NCE's name is XYZ, and they have invested into a partnership called ABC. Now, in that partnership ABC, there are three partners, A, B, and C, having 33.33%, 33.33, 33.34%. And whatever is the balance, so you need to disclose, even though you A, B, C are partner, and the C, let's assume that you are that is C is XYZ. So in that case, even though you hold only 33.34%, you are required to mention details of all other partners as well. So please don't forget to do that part. Then it says that aggregate amount of quoted investment and market value is required to be reported. Aggregate value of unquoted investment is required to be mentioned. That's the historical cost. In case there is any provision that is created that some of the investment is impairment or some investments are having problem in realization or it is imminent, then the provision is also required to be mentioned. As I have stated, in terms of partnership firm, you can see the footnote 1. The entire same set of disclosure is required for current investment as well. So this was only for non-current 2 years and the current one. In case of shares or mutual fund or anything, the face value and the number of units are also required to be reported. Then comes the non-current assets and inventories. The residue part that is on other non-current assets, where the security deposit is for more than 12-month period, or the prepaid expenses not of a next year, but even after that. So not getting due for the next year, but more than 12 months period. So that goes under the prepaid non-current asset. Same way, inventories are there. In case of a goods in transit, it is required to be disclosed under relevant subhead of inventory. So we need to mention that, let's say raw material includes goods in transit worth 100 rupees kind of reporting side. Then comes the trade receivable. Outstanding for a period less than 6 months from the date they are due for receipt. Very important one. So let's say your sales invoice or your sales contract says that you give 30 days the credit period. So the 6 months would be counted after 30 days. So from the date it is due from due for receipt, into which you have three part: secured and considered good, unsecured and considered goods are considered as doubtful, and provision for doubtful receivables. Likewise, for a period exceeding 6 months, the same set of disclosures are required, into which one more disclosure is required is an unbilled receivable. So many of the time the NC deals with an ongoing process or a long-term contract wherein the performance is carried out on a time-to-time basis. However, the billing is carried out on a predefined milestones only. In that scenario, it may so happen that the milestone might not have been achieved. However, the work is completed, a portion of the work is completed, which is still not billed. In that scenario, the unbilled receivable would also feature in it. Then comes the cash and bank balances. So into it, we need to have a cash and cash equivalent on a current account balance and the cash credit in case there is a debit balance. Fixed deposit with maturity of less than 3 months. Please understand this. Less than 3 months means It's an equivalent to the cash, and that is the reason it is being included into cash and cash equivalent and not in the other bank balance. Check and drafts on hand. Let's say some checks have been received, however, the same are to be presented in the coming period, that is, let's say in the month of April initial phase. So that would go under check and draft and then the cash. Other bank balances, bank deposits, earmark bank deposit, wherever the deposits are earmarked for something or lien mark for that. Deposits with original maturity for more than 3 months but less than 12 months from reporting date. So that goes under the other bank balances. Margin money or deposit under lien, right? So that goes under the other balances. One school of thought says that more than 12-month bank balances would not be considered as a bank balance per se into this one, but it will be considered as a loans, advances and deposits on a non-current side. However, we may take a call and put it in a different separate specific disclosure stating that way more than 12 months. So appropriate user would be in a position to understand better. Other current asset, so that's again a residue one, that is interest accrued but not due on deposits, or interest accrued and due on deposits. So now comes the statement of profit and loss format. Again, it's a bit changed one. Revenue from operations, other income. Expenses would have cost of goods sold. That's a new term, generally not being used in NC's financial statement. Employee benefit expense, finance cost, depreciation and amortization, exceptional items if there are any, partners remuneration, tax provision, deferred tax provisions, and discontinuing operations. Same way, revenue from operations, sale of products, less excise duty wherever there is an excise duty applicable. Now very few items would have an excise duty. So wherein you need to add up the value into the sale of product. But now wherever applicable, we need to mention. Sale of services and other operating revenue. However, the NC which you are auditing is an NC which is operating under the financial business. In that scenario, the entire reporting, that is revenue from operation, would undergo a change and it will be replaced with an interest and other financial services income, right? So please ensure that way to change that part. In that case, the other income would not have an interest income, but the primary income would be an interest income. So in case of a normal business, which is not a financial business, other income would be an interest income, dividend income, net gain on sale of investment, or other non-operating income, but we need to specify therein. Now, this is on a cost of goods sold, a bit tricky one. You won't find on the face of statement of profit and loss the closing stock and the opening stock. It would be now under the COGS format. So we need to first compute the raw material consumed, inventory at the beginning of the year, purchases, and at the end of the year. There will be a changes in inventory, that is work in progress, and finance finished goods as well. So along with that side, you can prepare the change, that is increase or a decrease in the work in progress or finished goods, as we do it in corporate SSE case. Same way, in case of a packing material consumption, it goes into the raw material, if it is considered as a raw material side, and other items. Employee benefits, same. I have a difference of opinion here in terms of an contract labor for employee benefits. Generally, we don't consider contract labor as employees. So in my opinion, it can be separately mentioned as a contract labor expense rather than including into the salary, wages, bonus, and other allowances, so as to ensure that in case of a labor law compliance, it does not come in way. So a separate specific line item can be included therein. So there are no rights created even by the figment of imagination by such persons. Finance cost, that's the interest and other partners capital and other borrowing cost. Depreciation, it will come from that clause. The last one on profit and loss, that's the other expenses. There is a list of host of line items given. However, there is a specific prescription into it. Any item of income and expenditure which exceed 1% of revenue of operations, or 1 lakh, whichever is higher, is required to be separately reported. Adjustment to the carrying amount of investment, is required to be specifically reported, and these are the items which are required to be reported separately. Now comes the question of whether cash flow statement would be mandatory. So I would say that for medium and small small medium enterprise, micro, small and medium enterprise, I would say that it's not mandatory. However, that reference is on accounting standard, so we'll go in detail in some time from now. However, ICAI encourages to comply with the AS3, that is the cash flow statement. Cash flow statement would have primarily three segments: operating activity, investing, and financing activity. Notes and other statements and explanatory material, as I have discussed earlier, the financial statement to include significant accounting policy as required by applicable accounting standard. It should include the additional information relevant to the needs of the users regarding disclosure in balance sheet and P&L, and it should include the supplementary schedules and notes. Now comes the applicability of accounting standard to NCE as amended at 433rd Council meet of ICAI. Now, this is the single snapshot of what is applicable and to whom. Category, only two category now, MSME and large. MSME, which are not engaged in a bank, financial institution or any insurance company, having a turnover less than 250 crore, borrowing less than 50 crore, whose equity or debt securities are not listed, not in the process of listing, whether in India or outside India, and is not a holding or a subsidiary of a non-MSME. So that's what is basically says that MSME, and large is the one who is not an MSME. All accounting standards are applicable to the large entities. However, some exemptions are there for MSMEs. Exemptions from accounting standard to MSME, if at all availed, it is required to be disclosed. In case of applicability of certain accounting standard in current year, which was not applicable in previous year, we need to have a comparative reporting as well. And in case the MSME is transiting from non-MSME to MSME, exemption is available only after completion of 2 years. Now, I am quickly going through in this one so that we can take important part at the this on what should be done in case of a non-compliance. So these are the ones the tabular form. Sorry. How to report in case of non-compliance, the red flags. Many of the members are asking, and this goes through across the social media platform as well. What I've done is, again, frankly speaking, now from this part onwards, nothing is there in the institute guidance note. This is all purely my opinion or my assessment. I have devised four, or rather, I have bifurcated these events or scenarios into 4 parts. Audit is carried out wherein no statutory requirement for audit and non-adoption of this guidance note. Audit carried out under section 44AB, or we know it as tax audit, and non-adoption of this. Partial adoption of this guidance note, and modified or a selective adoption of the guidance note. So let's go one by one. Let's understand where the problem would be and how to trade between that. First part, audit where no requirement. So many of the time, our client says that even though audit is not applicable, I would like to get my accounts audited. In that scenario, what would be the important one? That's the framework for preparation and presentation of financial statement would be applicable. It lays down guiding principle for preparation and presentation of financial statement. Moreover, the preface of the accounting standard, statement of accounting standard, deals with this one, which says that financial statements are required to be prepared as per the framework. At the link also I have given, so that can be accessed from therein. It also says that ensuring the compliance with the accounting standard while preparing the FS is the responsibility of the management. Financial statement cannot be described as complying with accounting standard unless they comply with the all requirements of all applicable standard, meaning thereby, if it is not complied with by the management, a non-adherence to presentation, that is FS of NCE as per guidance note, we are required to report it into the audit report. Now, as you all are aware, the audit report would be having two parts, that is basis of opinion and the actual opinion. So we need to mention, and the basis of for qualified opinion should include the departure from the prescribed presentation framework. We need to categorically mention what we need to do in this part. We also need to ensure that the qualification, that is qualified opinion paragraph, should include impact of financial statement on true and fair view, if any. By and large, there won't be any impact on true and fair view with the presentation side, or on financial positions, or on financial performance. All three aspects we need to touch upon while reporting into the qualified opinion paragraph. Then comes the 44AB. I have created this snapshot for a form 3CB. It says that I have examined the balance sheet as in so and so, profit and loss so and so, for the period beginning of so and so, ending with so and so. Second point, I certify that balance sheet and profit and loss are in agreement with the books of accounts. It states that these are agreement in books of accounts at the head office so and so, so and so. I report that following observations and comments, discrepancy, inconsistency. So that is one clause, or the one place where the option is available for qualification is clause number 3. Second is available at clause number 5. That is, in my opinion and to the best of my information and according to explanation given to me, the particulars given in the said form 3CD are true and correct, subject to following qualification. So it requires the reporting with respect to the 3CD aspect. Now, these are the extract from guidance note on tax audit under 44AB issued by ICAI. I think we are running short of time. I'll quickly go through it and we'll discuss on the important part. Okay. So 18.5. The paragraph 3 of 3CB, the tax auditor has to report his observation so and so, if any. The expression subject to above appearing in clause B makes it clear that such observation discrepancy which are qualificatory in nature relate to necessary information explanation for the purpose of audit, or keeping of proper books of accounts, or true and fair view of financial statement, respectively, to be reported under paragraph 3 under ABC. Right, whereas it refers to the other part, that is SA 700 and other reporting part. So at clause number 3 of form 3CB, or let's say that it's not a tax audit, some other audit where the financial statements are required to be commented upon, then we can mention that way that 3 points are essentials. Departure from presentation framework should be included. Its impact on balance sheet, because in case of 3CBF, as we can see, balance sheet item and profit and loss item to be spelled out. So in this case, what we need to spell out is that there is a departure in the presentation framework. However, there is no impact on the balance sheet or a profit and loss item. Whether the impact of non-compliance is materially important or not is also required to be spelled out. Right. So these are the 3 important aspects while drafting the qualification. Then comes a question where NC would say that I would like to partially adopt the guidance note, not in full or not in entirety. Now, as such, there is no prescription of pick and choose into this aspect. So it's not permitted. It has to be it is applicable on in entirety. However, if management chooses to adopt guidance note in part, the auditor is required to make appropriate qualification. Now, which are the part or the essential ingredient of qualification in this case? Fact of non-adherence to guidance note in entirety. Second one, specific clause or disclosures not adhered to. And without fail, impact of non-adoption of such clauses, disclosure not adhered on FS presentation. Right? In case there are any impact. Issue may arise in case of disclosure for borrowing, PP, classification of current, non-current, long-term, short-term. And for that, it may so happen that few of the NCs would say that we will not implement these part, but we'll implement the other part. Although it is not permitted, but it's again the responsibility of the management. And if they are going ahead with this one, our audit report should include this part. The last one. Someone would say that I would have a modified or a selective adoption of guidance note. Again, whatever is mentioned in guidance note is minimum prescriptive. Anything additional, yes, you can report. However, if the essence of it is being impacted because of the selective or a modified reporting, that is not acceptable. In that case, the auditor is required to include that part. I've included few examples as well. So same set of reporting guidance, that is fact of non-adherence in entirety, specific clause is modified or selectively adhered to, or impact of non-adoption of such clauses not adhered on financial presentation. Now, where it can happen. In case of borrowing, in absence of definite terms for repayment for unsecured loan from family members, friends, etc., the classification in long term, short term may hamper. So, in that case, probably this case might come in. See, this is for the first time we are implementing this. So, these are what I have thought of, that the issue may come up in this fashion. The second one would be in case of PPE, non-availability of information, the one that we have already discussed at the time of PP, that the gross value of PPE is not available. So disclosure is carried out with WDV as gross value for opening balance, even though it would vitiate the entire presentation. However, the such issues are required to be reported in audit reporting. So I have done with this my part. I know as the person on the screen that you see, a lot of things are going on his mind. You all would also have a lot of questions into it. I can see that a lot of beams are there on chat box and Q&A as well. Kenan, you can take it over. Based on that, I'll discuss this one.
Yeah, sir, let's take a few questions if little time will be permitted to us.
Yeah, so at the time being, I am closing this particular presentation. I'll first say thanks a lot to you, and now we'll discuss on questions.
Yeah, so first question is whether the new format is applicable to cooperative housing society.
Yes, I would suggest in that way that for societies, if the specific format is prescribed by the society registrar, in that case, no, it's not applicable. But if there is no format prescribed, yes, it is applicable. So, what is there in the legal precedent? If it is there, you don't need to worry on this presentation. It takes a priority.
Okay. The next question is like loan from relatives to be shown in the long term or short term.
Uh, Probably you have hit the landmine. That's the problematic area. See, let's understand what would be the impact. See, don't jump onto with any of the specifications like if you want to do it, we are doing it, right? If you report it in a long term, it takes kind of a quasi capital thing in terms of a banking parlance. In case of a short term, it may so happen that way that your maximum permissible bank finance would also not be there, right? Because it
Right.
may impact on a current this one. So I've touched upon that part. Need to ascertain what is there on documents. So
Right.
based on documents, if assuming that let's say the documents are sketchy, or in terms of say documents are properly not there, I would suggest that guide to this management, even though whether that is this format is to be applied or not applied, but at least that is required. So based on that, need to take a call that if the repayment is more than 12 months, or how the entire repayment is prescribed.
Yeah. So next is like attesting this a financial statement for submitting to the cash credit facility to the bank. Whether the same format would be applicable or the T format can be done.
No, this same format would be applicable across the board. So you don't need to prepare multiple financial statements. Rather, this format will give a lot of information for credit assessment,
True.
because you have long term, short term, you have non current, current. So that would be very much easier for the bank finance. Only thing is that those who do not have, I would say, very disciplined approach in current, non current, or the banking, this one may get some impact onto this.
Yeah, you might have already mentioned, but is it applicable to government corporation pension trust funds or the gratuity trust funds?
I would suggest wherever we can see under which provisions you are auditing, and the base act is required to be referred to, or act, or the rules, or the schedules. Wherever there is a format prescribed, go with that format. Don't need to you don't need to use this format. But if the format is not prescribed and only mentioned that way that it is required to be audited, then this format will be.
Right. The last will be the one. If someone have followed this presentation, can they go back to the old presentation?
Uh, See, again, I would say that it's the responsibility of the management. So I would not be forcing per se with a gun on his head,
Right.
right?
Right.
Obviously. So if they say that they want to revert back to the old one, that's fine. But then my as an auditor, my observation would be there in the audit.
Right. Uh, I think we have covered most of the questions. There were so many people who have
Yeah, I think
appreciated.
someone is mentioning that Q&A is also there. Is it visible to you?
Yeah. I have taken a few
Yeah,
questions from the Q&A as well.
you can take all as well. I don't mind. Except Dipti ji is not having any problem in terms of
Yeah,
keeping this
we'll
on.
take a few more. Like
Yeah, yeah.
uh, someone has mentioned that would reporting in separate or detailed schedule is required to be provided with the financial statement, like for data indicators, etc.
Okay. Let me be very clear into this one. Whenever you prepare a balance sheet, you are not supposed to or you are not required to provide the names of the debtors and the creditors. That is part of a grouping, right? So now
Right.
grouping is an internal document. Now
True.
let's take an example. Let's take an example of a very large listed company. Do you find any of the name of the debtor or a
No.
creditor? Rather, that is creating more problem to the entities, because in the competitor would have an access to from where he is
Obvious.
procuring and to whom he is selling. So I would suggest everyone please desist with it, whether you apply this format or not. But please don't mention the name, any names, no
True.
account numbers, bank account numbers or anything. Please don't mention such kind of thing. That is going to create more problem for the assessees or the auditing.
Yeah, one more query is like if there is no actual valuations for the gratuity, whether we have to qualify the report or not.
Okay, AS15 has some exemptions, less than 50 employees and kind of thing. I would suggest you refer to that exemptions first. There are multiple exemptions, not a very single one para exemptions. There are multiple exemptions and more than 50, less than 50. Right. So I would suggest please refer that part first and then take a call, because AS15 itself is a subject by itself.
True. Uh, I think we have covered this one. Yeah. So the last one, what if the NCA has invested in the LLP, whether the partner's detailed ratios capital is to
Yes.
be given?
Yes, LLP is not a corporate entity per se in terms of reporting. This reporting, LLP has certain essence of corporate entity, but for this it is considered as a firm, in my opinion. If a member would like to defer it on that count, that's call. But that is having more essence of firm rather than of company in terms of this reporting side is concerned.
Yeah, that's it. Thank you, Kuntal, for such a wonderful live examples and the presentations. Let me close the sessions, formally close the sessions. As we come to the conclusion of this session, I would extend our sincere thanks to CA Kuntal Shah for delivering such a structured, relevant, and insight presentations of this NCE clarifications. A special words for the CA Dipti Jain and the Gyan stations for giving us the platform where we can share the knowledge to all the professionals like us, to all the associations, ITBA, AGFTC, TAG, Choice Group, and special Gyan stations for arranging these seminars. We request our participants that follow our YouTube channel, GyaanStation. You will be find all the live seminars and webinars which are recorded and available there. Sir, many people have requested for the PPT. If you can share, we can share it to the members. Your voice is not coming. I think you're muted.
Yeah, sorry, sir. How do you wish to have it right now to be posted into this
You
one, or
share it to us, we'll share it to the members.
okay? So will that reach to everyone?
Yeah, yeah,
Those
yeah.
who have
Yeah, yeah, yeah.
okay, fair enough. I'll send you in some time.
Yeah,
Actually,
yeah,
I
no
have
worries.
2-3 calls lined up because they have
No
already
worries,
called
no
me.
worries.
Right.
No worries,
So
sir.
I'll
No
finish
worries.
it off that, and by that time I'll also share with.
Sure, sir. Sure. Thank you. Thank you, sir.
Yeah.
So, thank you all the participants for coming and giving your time and learning through the Gnan stations. YouTube link is there. You can search Gnan stations. The channel is there. Thank you again, Kuntal sir, for sharing your knowledge. We formally close this webinar today. Thank you. Thank you, everyone.
Thanks. Yeah. See you. Good night.
Thank you.